On February 22nd, 2025, Warren Buffett released his annual letter to shareholders. This is a typical regular occurrence, but this time something bizarre and unprecedented stood out. A signal that serves as a warning for the entire global financial market. Now, you might argue that this is just speculation, and to some extent that's fair, but as you're about to see, the moves happening inside Berkshire reveal some serious red flags. The first thing you need to know is that Warren Buffett isn't the kind of businessman to issue warnings, nor has he ever publicly revealed anything that might compromise his long-term strategy for shareholders. The common read on him is to watch what he does and not what he says. In his 60 years at Berkshire, he has never come out and made a strong negative prediction. He has always remained balanced in commentary, straying from controversial statements even in the face of complete meltdowns. So reading into what his company is doing from a financial perspective is key in understanding what may come next and what he's actually thinking. Because trust me, as much as he says he doesn't predict the future, you can bet that he has a pulse on everything from a long-term perspective. Otherwise, he wouldn't be the most successful investor of all time. So with that said, enough psychology, let's jump right into the facts. For most of Berkshire's history stretching back to the 1960s, they have been a net buyer of stocks, simply meaning they buy more than they spend. This makes sense since after all, Buffett is considered the world's best investor, so why not utilize that skill set? However, as of Q4 2024, Berkshire had $334 billion in cash and has been a net seller of stocks for 9 quarters in a row, stretching back to Q4 of 2022. This has never happened in company history. Even more striking is the speed at which this cash pile is growing, signaling a level of caution we have never seen before. They started 2023 off slow, increasing their reserves by about 3% per quarter. But in 2024, Buffett did something unprecedented. He started aggressively offloading Apple and other major stocks, causing the cash pile to grow by an average of 16% per quarter, totaling an astonishing 81% over the year. No matter how much he insists that this is normal or tries to downplay it, there's simply no way you sell this much unless you believe something big and potentially very bad is on the horizon. In fact, if you ask Warren how he feels about the current state of the economy, his response speaks volumes. This is a clip from an interview on March 3rd, 2025. Listen closely and decide for yourself whether this sounds like the reaction of someone confident in the markets.
Can I just ask you a couple of questions about kind of how you see the state of the economy right now?
Well, I think that's the most interesting subject in the world, but I can't talk about it now. I really can't.
How do you think tariffs will affect the economy?
I mean, tariffs are actually, we've had a lot of experience with them. They're an act of war to some degree.
So in that clip, he essentially says he can't discuss the economy and even suggests that tariffs are an act of war. If we assume that chaos is on the horizon, Berkshire's massive cash pile starts to make perfect sense. In fact, we've seen this pattern before, looking at Berkshire's cash reserves from a 3-year average perspective dating back to 1999, a clear trend emerges. Before the dot-com bubble burst, Buffett was steadily building his reserves, and while he didn't deploy as much cash as some might have expected between 2002 and 2004, this wasn't entirely surprising. Buffett has never been a big fan of tech stocks. Still, the data is clear. He was stockpiling cash ahead of a crash and then putting it to work when the market collapsed in 2001 and 2002. And then in 2004, the same trend starts to emerge again. He begins growing that pile again, and in those years, he begins to make subtle statements regarding the future of the market, specifically the housing market, which would obviously go on to crash in late 2007. Now, of course, he never flat out said we would face the biggest recession since the Great Depression, but there were clear signs from his statements that something just wasn't right, and it's remarkably similar to what is happening now. Take a listen to this question from the 2006 annual shareholder meeting, where in my opinion, he essentially predicts the 2007 crash, and it's reinforced by his massively growing cash pile, which coincidentally is growing at rapid pace at the time of these statements.
Number one again.
I'm Lori Gould from San Francisco, California. My question is, what are your thoughts about the residential real estate market in the U.S., where it's headed, and how is California different, if so?
Well, Charlie's our California expert. We've managed one time to develop a great piece of property in California, and we spent about 20 years or so developing it, Charlie?
I'm going to skip over the start of this because he begins his answer with a long story about a California development project he was involved with that essentially breaks even over the course of a 20-year period. This was due to fluctuations in land costs, stating that they sold at the wrong time and could have made 10 to 20x their money if they held out. But this story leads into the main point: the speculation in the housing market during the peak of the housing bubble right before the big crash in 2007.
You know, it's a wonderful, the climate is wonderful, everything's wonderful about this property. It's just that from time to time, even in great localities, you've seen it happen in New York a couple of times, you know, in the last 30 years, where the swing in properties values has just been huge. And what we see in our residential brokerage business, and we're in I don't know how many different states, is we see a slowdown every place. Now, we see it most dramatically in some of what have been the hottest markets. And the markets where you're going to, in my view, you're likely to see the greatest fall off and where you've had the biggest bubble are the ones tend to be the high-end market, and they tend to be ones where people have bought for investment or speculation rather than use. $100,000 for a house and mortgage it for $270,000, and if the value goes to $250,000, if they have a job and everything, they won't move out. I mean, you don't lose a lot of money, even though the market value on a given day is less than the loan value when families stay together and employment is present and all that. But when you have investment type holdings or speculation type holdings, when you in effect have had the day traders, you know, of the internet move into the day trading of condos, then you get a market that can move in a big way. First, it sort of stops, and then it kind of reopens. Real estate is different than stocks. If you own 100 shares of General Motors, it's going to trade on Monday, and that's what it's worth, and you can't kid yourself about it. But if you own real estate, you know, there's a great tendency to think about the one that sold down the street a few months ago. And there's a great tendency to think, you know, you only need one buyer who hasn't gotten the word that things have slowed down, and you'll make your sale. I can tell you that in Dade and Broward County, for example, in Florida, where the average condo is about $500,000, if you go back to December of 2004, there were less than 9,000 condos listed for sale, and I think 2,900 of them sold in the month. So you were turnover one every 3 months, less than that. Now the listings are up to 30,000, and the sales are down to under 2,000 a month. Well, 30,000 is $15 billion worth of properties, and you were very likely. You can get real discontinuities in a market like that, where all of a sudden people realize that the whole supply-demand situation has changed. So I think we've had a bubble to some degree, and it's very hard to measure that degree till after it's all over. But I would be surprised if there aren't some significant downward adjustments from the peak, particularly in the higher end properties.
So let's just quickly break down what he just said and align it with what's happening right now. In 2006, the Berkshire cash pile was growing at unbelievable pace, about to hit a record high. 1 year after those words by Buffett, the housing market crashes, starting in cities like Miami and Phoenix, and more specifically in the extremely overpriced condo markets. Going back to the clip, Warren essentially says that in Dade County, the months of supply figure for condos had gone from 3 months to something way more extreme. He also says that typically before a real estate crash, the market will pause before prices go down after people realize just how much inventory has piled up. And of course, this is exactly what happened in 2007. Looking specifically at the condo market in Dade County, prices here dropped 50% in a lot of neighborhoods, and even more if you looked out for distressed sales. While the Case-Shiller shows this drop on official reports, many people were able to get deals much bigger than this, with some prices falling as much as 80%. Now, this Miami story was a mini case study for the rest of the country, as prices all over the place plummeted and eventually caused a chain reaction leading to a worldwide financial meltdown. Of course, Buffett swooped in with his massive cash pile and bought great companies for pennies on the dollar, exhausting his cash in the years following 2007. Since that date, as we've discussed, he has been growing that pile to record amounts while making similar subtle remarks regarding today's market. A quick look at Miami's condo market shows 16 months of supply, which is a massive change compared to the pandemic lows, where months of supply was nearing 1 month. For much of the country, real estate is at a standstill with prices flat and volume very low, which if we follow Buffett's logic, we know what's coming next. Align this with the cash pileup and you have a wild coincidence emerging with a near perfect setup for another Berkshire sweep. Right now, there are wild shifts happening in the housing market, and Buffett's cash pileup can no longer be excused as just a market adjustment. This is something bigger, and time will tell if he ends up right once again. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it. And if you're in the Miami-Dade area, let me know what you're seeing, especially for those involved in the condo markets.